Good afternoon. Today, my group members and I will be speaking about the importance of environmental finance in portfolio analysis. Climate change is posing a complex set of emerging risks to the global economy. It affects an investment portfolio through two channels of transmission. Directly, it elevates weather related physical risks to real properties, agricultural production, resource landscapes, and infrastructure assets. This risk extends to market risk in equity holdings with material business exposures in climate sensitive regions. Indirectly, it triggers stricter environmental regulations and social norms, leading to a higher cost of emission and lower cost of green technologies for companies, which consequently induces downturn in carbon intensive industries. Studies exploring the underpricing of carbon risk by the market perform studies on returns of environmentally conscious indices and find that 4 of the 5 subject indices outperform the S&P 500 benchmark, thus confirming the potential of managing the portfolio profitably under climate change. Another researcher, Hendricks, studied the performance of three portfolios representing combinations of carbon intensive and clean energy stocks and found that the portfolio which replaces emission heavy companies with clean energy firms shows better performance under a series of metrics. Current risk mitigation strategies focus on divestment of positions in carbon intensive industries. The relevance of sustainable finance is attested by the above factors and also by the initiatives implemented to promote it by organizations and institutions. For instance, the Abu Dhabi Global Market or the ADGM aims to develop sustainable finance hub that supports capital formation, raising and deployment as well as creation and issuance of products to achieve positive economic, social and environmental objectives. Therefore, sustainable finance plays a huge role in the achievement of these objectives.
ESG investing changed the investment landscape. ESG stands for environmental, social, and corporate governance. ESG investors examine criteria within these three categories to identify companies that perform well using ESG related metrics. The pandemic has only strengthened the case for ESG investing by raising public awareness of social issues that fall under the ESG metrics. In addition, the resulting market instability produced further evidence that the stocks of companies with strong performance on ESG issues are usually less volatile. Also, research shows that the investing method can reduce portfolio risk, generate competitive investment returns, and help investors leave a positive impact on the environment and the society as a whole. In addition, companies prioritizing ESG issues actually generate superior long term financial performance across a range of metrics. Furthermore, in 2020, investments aligned with the 17 Sustainable Development Goals have increased from $8 billion to $11 billion at the New York State Common Retirement Fund, and other funds are planning to increase their green investments.
I'm Denzel, and I'll be talking about green bonds, which are financial instruments that have become an increasingly popular addition to portfolios over recent years and serves as a perfect example of the growing importance of environmental finance in portfolio analysis. A green bond is a type of fixed income instrument that is specifically dedicated to raise money for climate and environmental projects. They are designated bonds intended to encourage sustainability and finance projects aimed at energy efficiency, pollution prevention, and sustainable agriculture, among several others. They also finance the cultivation of environmentally friendly technologies and the mitigation of climate change. You see, there are a number of reasons that clients may be interested in adding green bonds to their portfolios, which has been the case over the recent years. The primary incremental benefit that green bonds provide is an impact investment, right? Investors in these bonds know that they are directly funding projects that address environmental challenges. Additionally, green bonds also provide attractive fixed income returns and come with tax incentives such as tax exemption and tax credits, making them a more attractive investment compared to a comparable taxable bond. These several factors have increased investor appetite for the instrument and has even led to many firms such as S&P, Bank of America, Barclays, to launch green bond indexes by themselves. You see, the future for green bonds appears very bright. The need for capital for climate-related investments in the coming decades is immense, and the fixed income markets will need to provide a large proportion of that funding. And as such, green bonds do provide that sort of funding, which is essential. And if you assess the situation with green bonds and green bond markets, you'll find that they're regularly oversubscribed today. And as such, it shows that the demand appears to be growing among investors who are focused on sustainability. Because for them, green bonds provide a powerful opportunity to pursue positive environmental change while also earning attractive fixed income returns. And as such, they can play a crucial role in an investor's bond allocation.
Hi everyone, I'll be talking about the impact investments. Now, impact investments are those investments which are made with the sole intention to generate a positive impact on the society and the environment, along with the financial return on the side. Now, some positive effects of this is the feel-good factor. Now, the feel-good factor is a sense of happiness or fulfillment that an investor may get for doing the right thing. In a sense that an investor might invest for the purpose of for the benefit of the society and the environment, rather than just for the financial return that he'll be getting. Also, nowadays, the majority of investors, you can say, prefer investing in impact investments because, as previously mentioned, they are for the benefit of the environment. And so this will benefit businesses as more investors will invest in them. Now, excuse me. Now, it is important to know the drawbacks of these type of investments as well. So, one of them is that some investment opportunities may be wasted, as in the good investment opportunities, because you may be thinking to invest in a environmental friendly investment, but that investment doesn't necessarily lead you to a higher financial return. And yeah, for example, like let's say an investor might invest in a company which is environmentally friendly, but it won't generate him a financial return if he would have invested in a non-environmentally friendly business. And below are a few examples of companies that made the difference with impact investment. So we have some retail investors, corporations, banks, and investment advisors. Thank you.
So I'll be talking about green sukuks. And as we know, as Denzel spoke about the green bonds, another type of green investment similar to the green bonds is the green sukuks. They're often referred to as a Sharia compliant bond and are complying with the Islamic principles. Since riskless returns are not like Sharia compliant, these bonds are usually equity based financial instruments. Now, how does this work? When purchasing a sukuk, the investor obtains a certificate of entitlement. The issuer in turn uses the proceeds to purchase a real asset. The owner of the certificate has a legal entitlement to a part of the underlying asset and as such periodically gains a share of the profits instead of earning a rate of interest. Now this means the investor is aligned as a shareholder to the underlying risk and as well as to the underlying asset, and it's therefore taking part to both the risk as well as the potential rewards. With the first green sukuk being issued in 2017, there has been an increase in the demand for sukuks. However, there is a very minimal presence of the green sukuks, so there's a very little availability there. It mainly focuses on funding sustainable projects like solar parks, railway systems, and many more, and they avoid generating any income or use any source that is unethical and is not Sharia compliant. Looking at the future of the green sukuks, it does look very bright in terms of how they are able to create and stimulate an economic development for any of the issuing countries. And with their ties with international communities and their exposure to different countries, it enables a high demand for the green sukuks. Especially when they're focusing on achieving a 4 trillion mark in the market, green sukuks help achieve the many different SDG initiatives developed. Looking at why we should consider investing in a green sukuk. If you're going to add a green sukuk in the portfolio, it's just like any other bond, right? So it does provide some stabilization in the portfolio. It also has a very low volatility, so it's like an added advantage. And thirdly, it exhibits low correlations to the other fixed income sectors and obviously equity markets and even commodities like oil, which is like fluctuating these days. Finally, according to research, 65% of the investors take into consideration the ESG aspect. Now, the ESG reports has been able to provide signals regarding the companies to their investors and help the investors make like the right decision choice. With that being said, it is of utmost importance if the environmental aspect is included into the company reports and into the financing sector, since it will help create transparency and would build a trust between the investors and the company. With this, we come to an end to the presentation. Thank you so much for watching.